Let's just say, firstly, an amazing first half of the year. And despite all of the tribulations of that period in relation to the war and the rise in oil prices, the reason I think equities have done so well is because earnings have been broadly very strong. And that's been true across all of the main regions through the last 6 months, in fact, the last year. And I think what's really going to drive equities in the second half of the year, again, is fundamental earnings growth. And there are two, I think, drivers to this. One of them is that earnings are really a function of nominal GDP, real GDP plus inflation. That's what drives sales and revenues. And that still is reasonably healthy. And secondly, the massive increase we're seeing in capex around AI commercialization is not just driving parts of the ecosystem in technology, and particularly the chip and memory stocks, but also spilling out into stronger earnings growth and cash flows in many of the infrastructure companies that are helping to support that build out. So I think earnings are going to still be the driver in the second half. They're likely to be weaker, but still pretty healthy. And I think equities will make reasonable gains and be relatively broad-based.
How long does that effect of capital expenditure filtering through wider parts of the market last? I mean, is there a question that we're in the peak of this now and that perhaps the effect will peter out over time?
Yeah, I mean, at some point, of course, there is going to be a slowdown in demand for compute. It can't be limitless, and there's also going to be an increasing focus on the cost and price that users or consumers of AI are willing to pay to achieve that technology uplift. But I think we're still some way away from that slowdown happening. It's also worth noting, Stephen, that it's not just the increase in capex around AI which is important here, but that we're in the early stages of a multi-year increase in infrastructure and capex spending coming from other factors as well. Remember, governments around the world are borrowing more money, and some of this is being spent on upgrading infrastructure, making supply chains more resilient in a more uncertain world, improving and strengthening energy capacity and distribution, as well, of course, as upgrading defense spending. All of these things require huge amounts of capital spending. A lot of it is on physical assets, and therefore, for the first time in really a generation, there is an increase, and probably quite a sustained increase, in investment and capital spending happening across most of the major economies. And that's, there'll be ups and downs, no doubt, but I think that's an important underlying theme.
Another theme of the first half of the year, Peter, has been the influence of retail investors. Does that change how you put your outlooks together when you have to consider such erratic, volatile behaviour? Yeah,
well, firstly, the massive increase in retail investors hasn't been true everywhere. That's mainly been true in the US. It's been true in parts of Asia. And I think that does, is a sense reflecting a vulnerability that people are perhaps getting too overexcited about narratives in relation to things like AI. And of course, we've seen, in some places like the US, an increase in margin borrowing to access equities. And we've seen an increase in demand for leveraged ETFs, for example. Now, of course, retail investors have been consistently strongly buying equities, particularly in the US over the last 2 or 3 years, and they've done very well as a result of that. So they actually have been positioning in quite a healthy way. But overall, I would say private sector balance sheets, including household balance sheets, are relatively healthy. And there have been lots of strong wealth gains, particularly in the US, on the back of the rises we've seen in the equity market over the last 3.5 years. So it's something definitely to watch. And, if that becomes more speculative, I think it leads to vulnerabilities in a correction. But I think the underlying trend is still positive.
Well, you mentioned Asia. I think you're pointing to the Kospi. Do those gains that we've seen continue? Is it still a good time to get in on the Kospi before the second half of the year?
Well, again, let's put it in context. In the first almost half of the year, that market was up almost 100%.
Breathtaking, yeah.
And it had been up, I think, nearly 80% last year. Extraordinary gains. It is worth emphasising, though, that index is heavily dominated by two companies, which make up 60% of the index, and they are in the chip and memory space, which is at the hard end of the benefits of this capex spending, because that's what is really supporting this exponential rise in demand for compute. Our colleagues who cover that market are looking at the index growing earnings this year by 320%. So it's quite an extraordinary growth rate. Having said that, of course, any time there's any sense that you get a slowdown in the end demand for memory or chips, that is a very cyclical industry, and there will be a pullback. So I think it's important to emphasize that the chip sector is a cyclical sector, and at some point there'll be a slowdown in demand, and prices will adjust. But overall, we wouldn't expect to see the same kind of gains in the second half as we saw in the first half, but we have a positive view on the broad market.